there are two kinds of analysis available to the trader and the speculator. One of those is fundamental analysis. And in this chapter, we'll be looking at what fundamental analysis is and how to make the most of it for yourself. In order to establish both the state of the market and also the potential direction of any future movements, two types of analysis are undertaken. A trader can use technical analysis, or you can use fundamental analysis. Technical analysis is the study of past price behavior and the repetitiveness of the market participants. If you consider the marketplace as comprising of millions of human beings, then you may come to the conclusion that their combined behavioral traits will be entirely random. But the reality is that there's evidence that the markets are anything but random. But we will look into this in much greater detail later on in the course. Let's talk about fundamental analysis. Fundamental analysis is the study of economic factors and involves evaluating the potential effect which these may have on the markets. Now, I am educated from an economics and finance point of view, but I am a die-hard technician which will consider nothing but a price chart. However, I know that no one is ever served by having too narrow a perspective of the world. So what we'll be doing next is we'll be starting looking off very briefly at what is being released and when on the economic news front. There's no doubt that the fundamentals are what shapes the economic landscape, and therefore the decision-making process of the trader and the speculator. You can basically split down the fundamental story into four categories. You got the economic factors, you got the financial factors and political factors, and then every now and then you'll also have crisis factors. But the economic factors differ from the three others in there's a degree of certainty about their release. The dates and time of the economic data are known well in advance, at least in most developed industrial nations. And as a trader, I have a check sheet that I go through every morning in a similar manner to the pilot who goes through his or her pre-flight routine. And one of those checks involves identifying economic news due to be released during the trading day. And why am I saying this? I'm saying this because if you have ever been caught out by an economic news release which you didn't know anything about, you will most likely remember that event forever, especially because it induced a rather painful loss or a beautiful profit on your trading account. Daily, weekly, and monthly news releases are available through your trading platform. The release of this data will often drive the market significantly in one direction as longer-term traders adjust their financial models. Economic indicators occur in a steady stream throughout the trading week. In the regulated market environments, they are always released at a specified time during the trading day. Economic data is generally released on a monthly basis, although some numbers like GDP numbers are released on a quarterly basis. But all economic indicators are released in pairs. The first number reflects the latest period, whilst the second number is the revised figure for the month prior to the latest period. For example, in July, economic data is released for the month of June, the latest period. In addition, the release includes the revision numbers of the same economic indicator figure for the month of May. The reason for the revision is that the department in charge of the collation of the economic statistics in a better position to gather more information 1 month after the period has gone. This feature is a rather important feature for traders. If the figure for an economic indicator is better than expected by, say, 0.4% for the past month, but the previous month number is revised lower by 0.4%, then traders are likely to ignore the overall release of that specific economic data. Whilst economic indicators are released at specified times throughout the trading day, their release does differ between countries. For example, in the United States, economic data is generally released at 8:30 Eastern Time and 10 a.m. Eastern Time. And it is important to remember that the most significant data for foreign exchange is released at 8:30 Eastern Time. In order to allow for last-minute adjustments, the United States currency futures market opened at 8:20, i.e. some 10 minutes before the release of the data. Information on upcoming economic indicators is published in all leading newspapers, including the Wall Street Journal and the Financial Times. But you can also access it on our own website's news service to receive the latest information in real time. Financial factors are vital to fundamental analysis. Changes in a government's monetary or fiscal policies are bound to generate changes in the economy, and these will be reflected in the exchange rates. financial factors should be triggered only by economic factors. When governments focus on different aspects of the economy or have additional international responsibilities, financial factors may have priority over economic factors. The realities of the marketplace reveal the underlying artificiality of this approach, or using the interest rates independently from the real economic environment translated into a very expensive strategy. As foreign exchange, by definition, consists of simultaneous transactions in two currencies, it follows that the market must focus on the two respective interest rates as well. This is the interest rate differential, a basic factor in the markets. Traders react when the interest rate differential changes, not simply when the interest rate changes themselves. For example, if all the G8 countries decided to simultaneously lower their interest rates by, say, 0.5%, the move would be neutral for foreign exchange, because the interest rate differential would also be neutral. You probably heard the old adage, buy on the rumor, sell on the news. Well, foreign exchange markets often don't move because of the fundamentals themselves. Sometimes they are influenced by traders' perception and expectations of the fundamentals and change in fundamentals. Factors affecting the trading decision include the time lag between the rumor and the fact, the reasons behind the interest rate change, and the perceived importance of the change. The market generally prices in a discount rate change that was delayed, and since it is a fait accompli, then it is neutral to the market. But if the discount rate was changed for political rather than economic reasons, something which is a common practice in the European monetary system, the markets are likely to go against the central bank, sticking to the real fundamentals rather than the political ones. And this is what happened both in September 1992 and in the summer of 1993, when the European central banks lost an unprecedented amount of money trying to prop up their currencies despite having high interest rates. The market perceived those interest rates as artificially high and aggressively sold short the respective currencies. And finally, traders deal on the perceived importance of a change in the interest rate differential. Political events generally take place over a period of time, but political crises strike suddenly. And they are almost always, by definition, unexpected. But currency traders, they have a real knack for responding to crises. They know that speed is essential. They know shooting from the hip is the only fighting option they have. They know that their reaction has to be instantaneous. And without fast reflexes, traders can be left out in the cold. And there's very little time for analysis. And frequently, there's only a split second at best to act. And getting back into the market can be very, very difficult. There's no time to digest the news reports. And you can become caught up in the emotional turmoil on the market. And although it can be an immensely scary place to be, it can also be an immensely profitable place to be. So as we go through these webinars, you'll be equipped with the necessary technical and the mental tools required to cope with these events. So stick with me and let's move on from the world of fundamental trading to the world of technical trading.